Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 31st, and this is the In the Know Trader Show. Well, after being down over 1% early this morning, the S&P has recovered. It actually went positive. It is up about 5 points as I talk right now, so a nice bounce off early weakness to see some gains. The dollar is up on the day. Oil continues to hover around $20 a barrel. And gold is down for the second day in a row as we're seeing some profit taking there. We're going to switch things up a bit in our shows going forward to get key S&P bond and dollar support and resistance levels, along with a new ETF trading idea each week. I'm going to recommend that you go to inthenowtrader.com/sign-up to become a subscriber of ours. And every Wednesday night, we put out a new report that looks at everything going on in the U.S. equity markets. We often refer to the bond market because it's very related. We'll talk about the dollar many weeks, sometimes gold too, with key support and resistance levels for those key macro markets. And then you get a new ETF trading idea each week, as well as review all open positions that we have on until they are closed out. So that is the weekly tactical trader report. And again, it's available on inthenowtrader.com. If you go to /sign-up, then it takes you directly to that page. If you want to find out more about myself, my background, and everything else, just go to inthenowtrader.com and you can find out and watch lots of videos and kind of get a sense of what I'm doing here and why this product is very different than other we'll say individual investor type market letters that are out there. Just as a quick note, I've been in or on Wall Street, let's call it, for 40 years now, and with both a significant trading background. My first 12 years were trading in the commodity pits, where I mostly traded stock index futures, but I also traded gold, silver, cocoa, and sugar, along with the stock index futures. So much of my background has to do with understanding how markets work, because I traded them every day for a dozen years in the pits. Then I went to the sell side at Morgan Stanley, eventually became chief market strategist there, and have worked at several other firms too since I left them, including Wells Fargo as head of cross-asset trading strategy. So when I designed In the Know Trader a couple of years ago, I did it with the intent of providing individual investors access to models that they generally do not have access to, and what often drives the decisions of many portfolio managers on the street. And the whole idea of In the Know Trader is to help align you, the individual investor, with how big money managers are thinking and where they're actually acting in the markets. And that's what you get when you sign up for the weekly tactical trader report on In the Know Trader. This week, we're going to concentrate on the gold market. We'll first look at gold bullion, and when I say bullion, I mean the actual price of gold. And then the rest of the show, we'll take a look at a bunch of the key names that make up either the GDX ETF, in other words, top holdings in the GDX, which is the most widely traded ETF for gold miners, as well as some key names in the XAU index, which is the Philadelphia Gold and Silver Index. So we've got, I don't know, about 15 names here or so that we'll take a look at after we take a look at gold and what I'm thinking there. So before we even get to the charts, what's gold's role in your portfolio? Well, it is essentially meant to be a hedge against the unknown, a hedge against potentially a disaster, a hedge against currencies. In this case, it's too much, in theory, dollar weakness. All these things are generally good for gold. Now, there are times that gold doesn't follow the actual historical pattern. So in other words, the dollar's up nicely this year, and yet gold is up 2. And last year, the dollar, gee, I'm trying to think if, net year over year, it probably was within, I'm guessing, 1% of where it was or started 2019. And yet gold still managed to move well higher. In fact, it got a significant move up starting in May last year. And so there are times that gold's not going to follow the dollar, but the point of having gold in your portfolio, traditionally people would say to have 3 to 5% of your assets in gold simply as a hedge, as a non-correlated asset, such that if the stock market came off, or again, problems with the fiat currencies, gold would be there as protection. And over the last 20 years, gold has been one of the best performing asset classes. So if you take from 2000 to 2020, gold was up probably more than any other asset, including the stock market, if we take that 20-year period. Now, once you start, you can make statistics say anything you want. If you take gold since the bottom of the stock market in 2009, stocks have done better. But again, in a just rough 20-year picture, gold has done remarkably well. And despite the fact that the equity market up until recently has pushed and pushed and pushed for years to new all-time highs, gold had done well too. So it is something that I recommend having as part of your portfolio if you don't. And what we're going to do today is take a look at the gold market and all these names, or at least try to get to as many of them as we can, and take a look at where they might be good buys or sales going forward. And that idea that you want to have, if you already have diversification, let's assume you're not 100% invested in equities, but that you actually have bonds as part of your portfolio too. Well, there's a reason you have bonds. It's mostly, think about it, there's two ways of thinking about it. One is for the income that you get from bonds, and depending upon the safety of the issuer, it depends upon just how much assuredness you have that you will get paid. But if you have treasuries, AAA bonds, AA bonds, even single A bonds, you can be pretty sure you're going to get your coupon payment twice a year. And if it's U.S. Treasury, in theory, you're virtually guaranteed to get that payment, as well as you would if you have AAA corporates like Apple, Microsoft, Amazon, etc. These are all highly rated bonds that the likelihood of default is so minuscule that you're going to get your interest rate as well as your principal back at the time that the bond is due. So you have bonds in your portfolio to offset equities, partially to get income and partially for the safety of them, that they provide a constant flow of income to offset the vagaries of the stock market, the ups and down periods. At least in a bond, you're going to get your payment. So it makes sense to me to also take a small part of the portfolio and have exposure to bullion, and probably gold being the best. Silver is obviously the poor man's gold. Platinum and palladium they're both precious metals, but often trade quite differently. In fact, palladium has become the most precious of precious metals over the last year or two. And up until things fell apart recently, I don't remember the exact high, but I think it was probably up in the neighborhoods of $2,700 or $2,800 per ounce. But that thing can move a couple $100 a day at times. So, it's a very thin market. It's not something I recommend you have, but gold to me makes sense. And it makes sense too because it's been the theoretical store of value for 2,000 plus years. Gold coins go, back to well before the year zero. And, I mean, I'm not a history buff, but I'm pretty darn sure gold has been something that has always been meaningful to humankind as far back as we kind of have history recorded. And when you think about Bitcoin or the blockchain and other type cryptos, they're hugely unproven. They swing wildly. And to my knowledge, the market is basically controlled by a half a dozen players. And then everybody else are pure speculators. And to me, at this point, I'd still say I'd rather have gold than cryptos in my portfolio, simply because cryptos to me seem to be extremely speculative with no real proof over time that they actually have any real meaning, and especially something like Bitcoin, which is also moving in huge percents constantly and can fall from 10,000 to 6,000 in a couple days. Something's wrong there. That's a regular event in that market, whereas obviously what we've seen in the equity markets over the last month or so is something that's rarely seen. So I'd like to have gold, and I think what we'll try to answer is as we go through these individual names too, is just how much gold do you want to have in your portfolio as a percent of your portfolio. So let's switch to the charts. And let's start off with gold. So on the left side of this chart, the peak high here was in 2011. That's when gold got to just over $1,900 an ounce. 1923.7 is the highest gold ever traded in the futures market on COMEX in New York. Then you had the significant bear market decline into the 2015 bottom, which got down to 1,045 or 1,042, I don't know, somewhere right around there. And then the move since. So let's look at a few things. And we've talked about this before, but just for those of you who are tuning in for the first time, when we look at this kind of 9 to 10 year picture of gold, most important thing here is really the base that was built, the years that gold traded back and forth roughly between, let's say, the low here at 1,050. And you'll see there's three kind of horizontal purple lines. Any one of them could be listed as the breakout point, but I kind of going with 1375-ish, kind of the middle of the three, as being the approximate range of 1,050 to 1375 was the range for those 6 years. And if you were to add $325, that range, onto, let's say here, where gold broke out last June, 1375 plus $325 equals $1,700. And sure enough, that's been virtually the exact high. 1704 is the highest front month gold has traded this year. So let's take a look. In fact, here, if I, well, before I switch to even a daily chart, there's something else of significance here. Take a look at what's the amount of time that gold spent here. And it's about 2 years, right? Because you had multiple bottoms. So gold spent about 2 years or so before it broke down from that range. Then we spend, as I said before, 6 years or so down here. And even though the gold bugs are hugely out there, crawling all over the place, calling for not just $2,000 gold, which would take out the all-time high, but $3,000, $4,000, and $5,000 gold, let's stop and think also about just dynamics of markets and the fact that if we have a 6 year base, yeah, probably over time there's more to go in gold, because this base kind of needs to resolve itself with all the sellers theoretically coming and buying gold back. But in the shorter term, let's take a look. From last summer, we're not even 1 year into this rally. And if you look at, let's say, here, let's take these ellipses off now, because if we look at, here, let's put this as a rectangle just so I can kind of highlight this area. So if we look in here, this is kind of where the breakdown came from. So let's just call it somewhere in the, I don't know, the 1550 area. All these lows that bounce, finally you break. And then you come back to that same area, pull back and move up. So we're not even 1 year into this rally, and look at where this market has hardly traded. So if I take the rectangle away and you look at how much volume was done above 1550 and how much volume was done beneath, let's say, 1400 or 1375, then it would make sense that we're going to spend time here, that we're not going to just completely zip off and make new all-time highs until we spend some more time here. So my guess is ultimately over time, yes, gold is going to go higher, but it could easily back and fill. You see recently, it actually got all the way down to 1451. And for institutional clients, we actually bought this pullback right there, and we sold half out yesterday. And I only sold half out simply because, and now I'll get to the daily chart. I mean, 3 times we've seen gold get up to near 1700 and fade. And it did it again. So even after this massive bounce that we just got a couple of weeks ago from 1450, we again can't get through this rough $1,700 neighborhood. So we've been consolidating in here. And basically I said, why don't we take half off? We got, you know, we're locking in almost $200 an ounce from where we bought it. And to me, if this is going to keep stalling, I don't want to run the risk that we give back 100 of the $200 we're up. So I've taken some off here, but I'm still long the other half. So when I look at bullion in the big picture, I can make the case that down the road, gold, there's reason to think that gold can challenge all-time highs and eventually push through it. In the nearer term, and I don't just mean for the next 2 weeks, but I mean for months going forward, I can't yet make the case that we're going to go materially higher after 3 times failing at 1700, which was that longer term initial upside target based on the measurement of the whole bottom. And I think we probably spend time in here. It could be, you know, the balance of 2020. It all depends. You know, there's too many factors at play now in the world that are unknown. Now, if we can push through 1709 and get a couple of Friday closes above that, then might I add that half back on? I probably would. But at this point, to me, it just makes sense to take some profit if I'm long gold and get back in, you know, if it breaks out. And understand that, you know, we could be here for a while. And look, next week or tomorrow, who knows? We could push through 1710 and keep going. And, you know, I got out too soon. But again, I also see that given the volatility that we've had over the last month, we could easily get down to 1550 down in here or even lower. So, you know, I was even thinking that there could possibly be a head and shoulders pattern that was developing where here's the left shoulder, here's the head, and, you know, one more rally would create a shoulder. And yet we went all the way back up to essentially test the highs. So, you know, to me, that pattern's kind of invalid as far as it developing. And if we got back down to where it broke out from, I'd certainly be a buyer, not only because of that's where all the old highs were. So anything, you know, 1350 to 1400 to me is a buy. But also if you look at the trend line off of last year's low, that also for the next several months comes into that same range. So there I'd be a much happier buyer of gold. But for now, as I said, I've taken some off the table. Longer term here, if I look at, let me switch this to a monthly chart. And I don't know what that line is. There we go. And I'm not even sure what this, oh, those are coming from different time frames. But here, given the rounded bottom, can I make a case for, you know, $1,900 gold being retested over time? I can, but there's huge resistance theoretically in this area. And therefore, I just think we're going to spend time here before we see it probably move higher. And if it moves lower, I'll be a happy buyer. Okay, so that's Bullion. Now let's get to some of the names that I had listed before. So let's start with Newmont. Some of these charts are going to look the same because obviously gold names are going to trade similarly, but you'll be surprised at some of these names looking very differently than other ones. And I'll try to point out when I see something that looks rather significantly different. So look, in 2020, Newmont took out the highs from 2016, got a lot of people to buy on what they saw to be a breakout. I was already cautious from the sequential 13 count in here, so I didn't add anything here. This got all the way back down to $33 just a couple weeks ago. It's back to 47. That probably, I'm just eyeballing it, but I'm guessing that looks like it held the trend line from the lows. Let's see. Yeah, it actually went right to it. So this is a name you can buy on pullbacks. Ultimately, I'm going to look for $60, the low 60s here. I still have some upside propulsion, full exhaustion targets in that $60 neighborhood going back for a few years now. This move did not invalidate that. So here, this is the type name that on pullbacks I'd buy, ultimately looking for a $60 target. GOLD is Barrick. Notice the difference. I'm going to go back to Newmont just so you kind of see. Look where we are in this chart. I'm not going to change the time frame. And look where, let's go back to Newmont and look how much stronger Newmont is than Barrick, right? Newmont took out 2016 highs, and besides this, other than this, quick swoosh a couple of weeks ago when all risk assets were taken down, this is not so far from the highs that it's been in the last several months. Go back to Barrick, and this is a totally different looking picture. It basically tied the 2016 highs. It's still beneath it versus the other one that's above. Newmont, that was above. So Newmont's the better name. Technically, this aims for anywhere from, I don't know, roughly 25.5 up through 27.5 as targets. And here probably if I go back to the 2015 low, which was the low when Bullion made its low, at least the sell-off held above that. So there's still a minor bullish bias here, but look, you go back years, look at that. Basically you have a mildly ascending triangle. You're not smack in the middle of it, but you're near it. Nothing to really do here. This is just buy on weakness. Franco-Nevada, FNV. Much stronger name. Look at this, even relative to the first chart. This made significantly higher highs in 2020 before the pullback. This is holding above its longer term uptrend line. So this is right now the best name that we've seen. Same thing, look for weakness, buy on weakness. And you're going to have to, because of how much these moved in percentage terms, this got from almost 75 to 100, right? So it rallied over 30% recently. If the market gives you a chance to buy on weakness, you're going to want to do it on the assumption that this still has room to go over time. But you can see the 13s and the 9s. So for those of you who have followed me for now, you understand that, from a timing point of view, this area in here suggested exhaustion of trend, and you got the pullback. So use pullbacks to buy into this name. Wheaton, WPM, different looking chart. 13 on the high of this year, the big move down. This looks like also, I'm just eyeballing, held. Yep, it held above the trend line. So same type of thing. Now look where this is though, all the way up here at 28 and change. Let's see, just bring in a little more here. So yeah, we've certainly broken that trend line a long time ago. We've broken this line. So this to me is a long-term rounding bottom, and we just recently kind of tested the low end again. You're going to want to buy on weakness given the opportunity. Let's go to AEM, Agnico Eagle. So this one, interestingly, actually is on a setup 9 count from, is it this week? Let's see, 7, 8, 9. It's actually this week. So as long as this week closes under 5's close, which it will, this is 9 count. It's imperfect. I'd probably buy this name and buy some more on weakness. But even now, I think you could probably buy the name. And this held support. So same type thing. If we draw a trend line, you broke through it intra-week, you closed above, you're still hanging right around there. Here's your propulsion exhaustion signal. You're not that far from that. So this is probably the closest to, from a timing point of view. And look at the 9s, 9 bottom, 9 bottom, 9 bottom, and here now potentially a chance for a 9 bottom too. So these are from timing models. These are important potential turning points. So this probably becomes one of my favorite names in the near term. Let's look at, we've got a little over 2 minutes to go. Let's take a look at Pan American Silver. All right, so this is not a gold name, it's a silver name. Basic double bottom here, stock's up at 15. This trend line did break intra-week, but we didn't close beneath it, so it's still basically holding trend line support. You probably added some new longs into this whole area that took out the 2016 high, same type 13.9, similar type signal, spike up, and then big move down. As best as I can tell, that's probably as low as this is going. So again, buy weakness, and that's been a common theory or scenario here. Hecla Mining, HL, different looking chart. Way beneath 2016, 2017 highs. Here's your 13s, suggesting exhaustion of trend. Heck of a good signal. Here's 113 that took you sideways for 6 months. Here's another one, a little early. This is a name I don't particularly love. It is somewhat near longer term support. But if we go down a little bit lower, every single buyer for years would be underwater. So I'm not in favor of this name. I just think there are better names out there than this one. What do we have? Let's say Harmony Gold, HMY. Similar, small type gold mining name, and don't love it. Still just all part of a long base. So I'll just say not one of my favorites. AGI Alamos Gold, similar type look. This is a name I actually own, but I've had it for a while. Not the greatest looking chart. Okay, it held exactly where it needed to on the sell-off in 2016. But besides that, kind of a mediocre looking chart. We'll do one more. Let's do El Dorado. EGO. Same type look. I mean, look, years and years of down market. It's okay, but nothing special here. This is better on a breakout above like the 2020 high, because then you got a clear shot to about 19 bucks. So that's it for this week. Again, go to intheknowtrader.com to sign up for our subscription. And this is Rick Bensignor, and have a good week trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.